Hi everyone, welcome to the Contra Turtle Show. I'm a 38-year-old Singaporean 9-to-5 worker. I live in a HDB, simple lifestyle, I've got no car. And on this channel, I reveal YouTube's most transparent stock portfolio and my journey towards a 4.5 million retirement fund over the next 12 years. In the last few episodes, many of you asked how exactly I find stock ideas and stay on top of the markets. So today, I'm breaking down the exact YouTube channels, newsletters, and some unexpected methods I use to spot opportunities and invest. Quick update on my portfolio. It currently stands at 460K, of which 187K are gains so far, out of 272K that I've invested in terms of capital into the fund over the last 4 years. In terms of performance, on a money-weighted rate of return basis, my portfolio has got 31% compared to the S&P's 8.2% and the QQQ's 10.3% on an annualized basis. On a time-weighted rate of return basis, my portfolio has gotten 18.4%, SPY 7.8%, QQQ 9.3%. So I've beaten the market over the last 4 years. I think it's still too early to tell, to be honest. I usually think that 10 years and beyond is a better judge. So I'll give it 6 more years before I conclude if I have an edge against the market. This is my allocations at the moment. I only invested in 5 stocks so far. I deem them as my tier 1 stocks. These are companies within my circle of competence, mainly in technology, which is where I work in. Netflix is my best performer so far. It's really returned 152%, so that's like a 1.5 bagger stock. No, actually it's a 2 bagger stock, sorry. It's more than a 2 bagger stock. And I have 6 companies on my tier 2 watch list, but I haven't found an opportunity to invest in them because my tier 1 list takes priority. So you might be wondering at this point, if I add your tier 1 and tier 2 lists, you only have 11 ideas so far. The truth is, these 11 ideas were actually filtered from over 100 companies or ideas that I found using resources that I'm about to share with you. Now, many of these companies actually failed my selection criteria and ended up in the not for me pile. So even though it may look like I'm gambling on 11 ideas, actually I'm super kiasu and super kiasi one. It took me a damn long time to filter down to the select few companies. If you're interested in my stock selection criteria, you can take a look at the video that's appearing right now at the top right hand corner. But yeah, let's get started on the tools that I use to find new stock ideas. First, we have the super investors. So I use a free website called Dataroma, where it shows the latest stock holdings of super investors. I like to look at Buffett, Kantesaria, Lilu, Poland Capital. Some of the common traits that I look for are they're all bottoms up investors. Look at high quality compounding companies and then they hold them for the long term. They steer clear of macro predictions like when the Fed is going to cut rates or when Trump is going to PMS. They don't do special situation plays like M&As or bankruptcies, etc. Also, it's really important, of course, that they are beating the market. They have beaten the market before for at least a period of 10 years. I also prefer investors with a more concentrated portfolio of high conviction ideas, or ones with a technology focus where I can sift out some ideas. Last but not least, their funds should have minimal movements, which means they don't really trade in and out of positions. They have more like a owner mindset than a trader mindset. So for example, if we look at Kantasaria's Valley Forge Capital portfolio, there are only 9 names in his portfolio and barely any buy or sell activity. He's focused on identifying high quality companies with pricing power. He buys them and then he just leaves them alone. I think good investing is really like watching paint dry. You almost have to go against your human nature, avoid being itchy backside and then touching your portfolio all the time. So I follow this style very closely. So my portfolio is also very small. I hardly have sold any shares since I started. But it doesn't mean you have to follow my style. You should take some time, study some of the super investors you're interested in. Obviously, make sure they are beating the market consistently and then figure out which style suits you the best. Now, one warning I'd like to give all of you, be very careful. Refrain from copycat everything, okay? From wholesale copying everything. We call this coattail investing. You should understand the thesis behind why you buy the company. Because what if tomorrow the stock falls by 50%? Remember the super investors, right? When they file their holdings, right? They only do it every 3 months. So does that mean you're going to wait for 3 months before you decide what you're going to do? Then because you're just waiting for the super investor, right? Must form your own opinion, guys, before you own the stock. Okay? Otherwise, it's a bit like in primary school when you copy your friend's homework, then your teacher suddenly asks you to go up to the whiteboard to explain your answer. Then you kalang kabok. Okay? Please don't do wholesale copying. Secondly, the valuation of the super investor stock is not disclosed in the filings. So you don't know what price they got in. You only know that they bought the stock, but you don't know at what price. The company can be fantastic. But if you buy at a price that's too expensive, then you're simply not going to match the same performance as the super investor. Next, I want to introduce my favorite method of finding new stock ideas called Scuttlebutt. This concept was invented by the turtle on the left, someone named Philip Fisher, and he wrote my favorite book called Common Stocks and Uncommon Profits. This book is actually also endorsed by Warren Buffett himself. So if you're interested in growth investing, I highly recommend this book. The Scuttlebutt method is very simple. At work, right, you just ask yourself, who are the suppliers that you work with, the companies, the products that you interact with? While you're speaking to all these people, ask them questions. Get a sense of how well their company is doing. What's so unique about the products? Pay attention to the tools that you use at work. Are they great? Do you enjoy them? Then from there, go through these ideas, go through these companies, find out what are the companies that produce these products, and then you get some ideas to invest in. This is really powerful because you are basically investing within your circle of competence, which is the field that you work in. You know, I have a friend, he is a medical doctor and he does surgery, right? He's been in the medical field for many years. And then the last few years, right, Nvidia stock rocketed, right? Went up. He started asking me, hey, should I buy Nvidia or not? Damn hot now, yeah. When I asked him why, he just told me, oh, because everyone is buying what? So basically, he just bought on FOMO, guys. Not because he understood the company. Then obviously what happened? Nvidia's price took a dip, fell. He panicked and then he sold. And then I asked him, why you sell? And then he said, oh, because the price dropped. And so he simply did not understand the company. He made the mistake of letting the price dictate the narrative of the stock and influence his investing decision purely on price, which is the worst mistake you can make as an investor. You know what's the funny thing? I was interested in this medical company called Intuitive Surgery for quite a while. I still am. I asked him for his opinion. Do you know he could tell me granularly, because he's a doctor, right? He's a surgeon. Oh yes, the Da Vinci robots, they're so good. You know, robotic surgery should take up more market share in the future. His colleagues in Australia, they're getting more trained on the Da Vinci machines that Intuitive produces. So it's incredible that he chose to invest in Nvidia, which is something he completely doesn't understand. But right before his eyes at work, there is a company he knows so much about, but he didn't buy. And, you know, he could have done so well in the company that he actually knows. So don't fall into this trap of the grass is always greener on the other side, guys. Look at the grass in front of you. And, you know, next you can actually ask yourself, what are some of the products that you use daily apart from work? All right, example, you use, I don't know, Google, Instagram, you're just surfing, scrolling, Lululemon. You know, how do you find these products? Talk to other people for their feedback. Even go and visit their stores and speak to the employees, find out more about their products. So you have some ideas of some companies that you can maybe dig into, right? And I did precisely this. Some time back, right? Lululemon, obviously, it fell quite a fair bit. I was like, okay, you know, I love pessimism. I'm going to do some investigation. I went to visit the Lululemon store in Takashimaya in Singapore. I spent over 2 hours at the shop, taking notes on WhatsApp that I shared with my investor friend. I was speaking to the employees at this Taka shop. I asked them, hey, you know, what's your best products? Actually, I was a newbie. I don't use Lululemon, right? And I had them explain to me why it's the best selling. I asked them how it works, how generally their operations run. You know, I experienced the entire flow as a customer, and I tried to find out what's so unique about their products and their business model and their customer experience to spot any durable competitive advantages. Now, I know what some of you guys are thinking, hey, then paiseh lah, go to the store, don't buy anything, ask so many questions, sibei thick face eh. Yes, guys, if you really want to do well in investing, you cannot just sit behind a book. You need to go out to the world, try the products, speak to the customers, speak to the employees, but have a bit of finesse lah, guys. Don't go up to the employees at the Lululemon store or some store and then say, hey, can you tell me how much I know you sell per month? How many units you all sell? Try to ask indirectly lah. Like, hey, what's your best selling product? Is it yoga pants? Oh, how come? Always sold out, is it? You sell like what? Hundreds a day or something? Then you can have a rough idea, right? So for this Lululemon exercise, I replicated the same Scuttlebutt process when I traveled to China for work. I actually went to a couple of Lululemon stores across a few cities in China, and I compared the crowd there versus Nike, versus Adidas, and versus their home brand Anta in each of the shopping malls to get an idea about the brand. While I was in China, I also visited in the shopping malls. They have all these EV showrooms. I did a scuttlebutt on the EV industry there. I spoke to the employees there. I spoke to every EV driver that was riding on the taxi rides here and there. And I asked them questions like, oh, how do you save on mileage? How much do you save? Why are you getting an EV? What's the sort of government sponsorship like, etc. I found so much interesting stuff. Like you see this picture on the right. I found this EV and they were doing interest-free car loans for 5 years. 5 years, guys. This feels like a bubble, man. There's just so many EV brands at the moment in China, and I just feel like at some point there's going to be some consolidation. But anyway, I digress. The point I'm trying to make here is go and scuttlebutt, do your research. While others go on holiday or go to the shopping mall to spend money on shopping, I go on vacations to find stock ideas to invest in. So the next time you're on holiday or you're at the shopping mall, pay attention to the products, the companies, and the crowds. Don't forget the scuttlebutt process. Now, one caveat about this point. Don't rely 100% on scuttlebutt to form all your opinions or the bulk of your judgment about a company or a trend. Marry your scuttlebutt with data. Go back and read the earnings reports, the management commentary, compare the data online with what you read versus what you've seen in person on the ground anecdotally. Because sometimes, right, when you speak to the employees or customers, right, there's a risk of a few loud voices that actually cloud your judgment. Maybe they could be just the few random disgruntled, angry customers or employees not happy. And then it just clouds your whole judgment. It might not be the full picture of the company. So you have to marry that with data that you read online. Balance in all things when you're researching a company. The next one, this one is probably the most underrated tool in the investment community, and it's Twitter, or now we call it X lah. Yes, this boomer tool. There is no other social media platform, guys, not even LinkedIn or Facebook, where you get the actual fund managers, the analysts, the government officials, CEOs of publicly traded companies voicing their opinions on the stock market and exchanging ideas or even critiquing ideas so openly. So you get to see this almost like their inner thoughts, the streams of consciousness, and get clues on ideas of what to invest in. So we even have a name for this. We call it Fintwit Community. I've broken down here a lot of categories. You guys can slowly go and take a look. You can skip all the tech ones. There's some really interesting ones, like in the second section here under the own investor section. This guy called Lutke, he did 21% for 21 years. This British guy, 21% compounding. That is crazy, superb record. I don't think I can even go anywhere near 20% for an extended period of time. He's like in his late 40s, fully retired. He lives off his stock portfolio. I think he runs a YouTube channel with a friend, which I'll mention later on. A very friendly guy. I've actually DM'd him on X before to exchange ideas because we have similar positions in AXON. Really living the life. When you watch his podcast, he's always on holiday, skiing all over the world. That's the kind of life I hope I can mimic when I retire. And then finally, at the very bottom, there is a special category. These are investors who are actually closer to home, based in Singapore or Malaysia. This guy, Singaporean, Eugene, he used to work in a bank. And then he did investing on himself. 7 years, he compounded portfolio at 19.9%. Brilliant. He runs his own fund called Vision Capital now. It's actually a friend of mine. We discuss about investment stuff here and there sometimes on WhatsApp. And he has a very unique VC style of investing, very different from mine. Another one is steady compounding. This guy also, I knew him through a mutual friend, Thomas. He used to work as a tax officer for the government, invested in the markets for the last 13 years, also did very well. And then he runs some investment newsletter also. And then Chin Investor, right here at the second last bottom, actually is this guy who writes for Straits Times. And he's some legend because, if I'm not wrong, he bought Netflix at some $30 price. And it's like a 300 plus bagger now. So it's pretty insane. Finally, obviously you can follow me if you want, but I don't really write a lot on X, so I'll let you guys decide if you want to add me on your feed. I don't think I can add much value, to be honest. So next we have YouTube. The first one is the very USA focused financial YouTubers. First on the list is Joseph Carlson. I would say among all the investing YouTubers, I follow him the closest. His investing philosophy is I'm the most aligned with him. We have similar positions in Amazon and Netflix. And I think both Joseph and I would say we fall into the Charlie Munger and Dev Kantesaria style of focusing on high quality compounders, concentrated portfolio, less than 10 companies. I'm in his Patreon community. I watch all his exclusive content. He's the most articulate, smart, and contrarian YouTube investor I've ever seen. But you gotta bear in mind, if you guys are into Netflix as an investment, some of his videos can be quite the echo chamber. I think it's important sometimes you even have to challenge your own positions so that you remain objective and you're ready to change your mind when long-term fundamentals do change on your positions. Then there's also this long-term mindset that's run by Baron Stoffel and Brian Ferrodi. Stoffel's investment style is quite VC-like. He has a mix of stalwarts, which are the large stable companies like Amazon, and then he also mixes them with some speculative plays. I actually discovered AXON from this guy, and it remains my second highest conviction stock. One of my favorite things about the channel is I actually learned the valuation technique called the reverse DCF method from them. I think it's the most logical way of valuing a stock in my opinion. So I think you should check them out. AcquiredFM, fantastic deep dives. They even had one recent one about Maurice Chung, the CEO founder of TSMC. Wall Street Wildlife is actually the British guy I talked about earlier on, the 21% guy, 21 years. He runs this podcast with a friend. And then the next section, which is psychology about how to invest, general macro about where we are in the market, and then just lifestyle philosophy. We've got Singaporean 1M65 Mr. Lu, Christopher Tan from ProvidendSG. Actually, they were the ones I credit that inspired me to have this concept of living in a simple HDB, investing in the stock market, building a retirement fund to have a fulfilling life in the future, and then sort of finding your ikigai along the way. Then we have Super Investor, which is a collection of just some old Buffett and Munger clips. Next, we have technology. I won't go through all of this. If you're not into tech, you can just skip this. And then last one is closer to home, some locals. The fifth person, they do very solid breakdowns of fundamentals, even some basics. They cover not only US stocks, but also China and local Singapore stocks. Dr. Wealth also quite similar. Backholder Pod is more lighthearted. I enjoy watching it for entertainment about investing in the local scene. There's Chiking inside, Calvin Learns Investing, the tuition guy, I forgot his name. Bunti, who is actually a friend. So semiconductor is not my expertise. I think by now you guys will know. That's why I don't own NVIDIA and ASML and TSMC, because I simply don't understand the businesses. But if you're interested, Bunti, he has a lot of insights into his semicon. His portfolio is double the size of mine, and he did very well with NVIDIA previously. So you can check them out. So next is a bit more old school, newsletter subscriptions. Most of my time is focused on YouTube and podcasts, so I'm very selective of my reading because there's very little reading time I have left. Strategy, run by Ben Thompson, very into tech. And then we have MBI, mostly borrow ideas. He's a Bangladeshi guy. Portfolio track record 16.1% over the last 7 years. Used to work at equity research on the sell side. He's known for these monthly deep dive writings. And then the last one is The Good Investors. It's actually run by Jeremy and Serging. They're Singaporeans. Serging is actually a good friend of mine. He did very well running his family portfolio. And they write a lot of articles about the current state of the market, some learnings. And on the topic of investing friends, I highly encourage all of you to reach out to any friends or family that are into investing. It really accelerates your learnings. I speak to my friend Serging on WhatsApp almost every day. I think I credit him for probably 30 to 40% of my investing philosophy. And he was actually the one that changed my initial thesis on Meta because I didn't believe in the company in the first place. Now, one caveat I want to point out, if you have investing friends around you that you exchange ideas, try to avoid the situation of what we call an echo chamber, right? Because what it means is that it's good to discuss investing ideas with friends, but don't make it to an extent that you guys only talk about all the good stuff about your shared positions. Then in the end, you're just parroting your same ideas again and again between each other. There's nothing new you learn, and you don't challenge your ideas. And this becomes very dangerous. It becomes like a circle jerk. Because then you become less objective about the positions that you hold, because you guys keep agreeing on the same thing, everything yes, right? And then it reaches a point where maybe somebody else challenges your position. Hey, why you invested in this? Then you get very defensive and you get very overly married to your position. And that is very dangerous because you should remain fluid and you remain objective. There are others like obviously Seeking Alpha, Substack, etc. I'll leave it to you guys to decide. One advice I have is to really make sure that you check their track record, right, to see that they're really beating the market over at least a 5-year period. Maybe on average a CAGR of 15% and above is safe enough. Because there are a lot of investors or a lot of writers, right? They talk a very big game. Wow, they sound like they are really good at the game, but they never show you their CAGR, like their returns, track record. So it's very hard for you to make an objective judgment on their investing ability. Okay. In fact, I think 10 years and beyond is even better than 5 years, because 5 years sometimes is really just luck. It's not really real investing skill. Actually, by that logic, I've only invested in the market for 4 years. So maybe you all shouldn't listen to me also. Just treat me as entertainment, okay? Alright, sometimes you may not be able to find friends or relatives in the investing circle. I understand that, okay? There's actually a Singapore and Malaysian Telegram investing community, very local, called Invest for the Long Term. I actually got permission from Bunti. He's the one that actually runs the channel, this Telegram channel. So, you can feel free to join it, but please be nice. Don't spam it. There's a lot of this semiconductor experts in the channel. There's someone called Webb. I really like some of his writings, and he put a lot of his discussions in the channel. He's focused on value investing. He did 18.5% annualized CAGR on a money-weighted rate of return over the last 5 years. Very impressive. He runs his own fund, and I really like his philosophy because I remember he said once that he believes a fund manager should own more than 50% of the fund that he runs. And I think he does that. I think he owns like 60% of the fund is his own money, something like that. So anyway, he has a blog here. You can check it out. He dives very deep into a lot of companies. I think his forte is insurance and financial companies. And he's always in the channel. So he's always discussing, so people asking him questions and stuff like that. I just have one request, guys. If you do join this channel, please don't ask people who the turtle is, because I prefer to be anonymous. I don't really want to answer Telegram. I'm really focusing a lot of my time here producing all this valuable content on YouTube for all you guys instead. Anyway, all these kokos are in the channel. They are way more superior than me in investing knowledge. And then their performance also better than me. You'll get higher quality learnings from them. So no need to ask me. Alright, so if you like the content so far, remember to give the channel a bit of turtle power, guys. And click subscribe, so you can be informed when I push out new content. I also love to hear from you guys about any other resources you use to find new stock ideas. So feel free to leave a comment below. I read almost every comment. Alright, in the last 3 episodes, you guys sent me 600 over comments. I answered every one of them. And sometimes I get really good questions, and even when I read it, it takes me even half an hour to do a bit of research before I answer you in the comments. So I take your feedback very seriously. So anyway, back to the episode. Now, next we have the very classic way of screening and finding stock ideas using a screener, right? I tend to follow this chart quite closely, and I focus a lot on stage 3 companies, which are still rapidly growing revenues, as well as stage 4 companies. They are growing revenues fast, not as fast as stage 3, but they're crunching out a lot more profits with more operating leverage. So because I'm very kiasu and I'm very kiasi by nature, I tend to only look for companies that have at least passed the break-even stage. They're actually net income positive. For example, like AXON, one of my holdings. So let me show you the tool that I actually use the most to screen, which is called FinChat. So this is the FinChat screener tool that I use a lot to sort of quickly sift through companies. So usually what I do is that I'll pick companies in United States and Canada. Over here on the right side, you have all the industries. I'll usually exclude the industries that are not within my circle of competence. So you can see there's a lot because I really don't know all these industries. I really focus on a very narrow niche that's within my hitbox of competence. Exchange, I exclude pink sheets. And then a screener, you can put all kinds of ratios, financial metrics, etc. But for very quick sifting of ideas, what I do is that I first set a market cap of at least 1 billion, because I think 1 billion and above, you get a bit more stable companies, just because I'm very kiasu and very kiasi. For revenues, I look at the past 5 years of CAGR. I want to see at least 15% of growth in the last 5 years. I want to see gross margins in the last 5 years is at least 50%, because this is sort of like a proxy of some kind of a pricing power, of a competitive advantage, possibly. That's why they can price the product so expensive. It's like how for GPUs and NVIDIA, they price their H100s and their H200 GPUs so high because the chips are more performant than other chips from other competitors like AMD, etc. Right? And so their gross margins are very high. So there's kind of a proxy metric that may give you a clue that this company may have some kind of a moat or some durable advantage. And then next is the gross profit of 5 years, the CAGR. I will at least match the revenue or more. And the reason for that is because we want to make sure that as the revenue grows higher, the gross profit should be the same or higher, so that you know that the gross margins are sort of they're sustainable, right? And then the last one is the net income. You can see I put $0, which means they have to at least be positive and above, right? So there's no maximum here, but it's just $0. Because remember earlier on in the stage 3 graph, I only look at companies that are net income positive and beyond. Okay, so this is the screener. And one other thing is, this is just an initial screen. So there's a lot of other due diligence that you still need to do. For example, like, you should check the debt levels. Once you, maybe, for example, you can look into like Netflix, and then, you want to look at their financials, and then you look at the revenues by quarter or by annual. You want to look at the trends. You want to look at their profit or profit margin and see how it trends over time. And then obviously you want to read their financials, their earnings reports, right? Copilot has this really cool feature called Copilot. FinChat has this cool feature called Copilot, where you can do things like summarize Netflix's latest earnings. So what it does is that it uses AI, and then it crawls through the latest earnings report, and then it summarizes the earnings report, and then it gives some additional detail like the pie chart, and then the earnings call, the actual transcript for management, and then some other related stuff. There's also resources here that you can sort of look at some of my favorite hedge fund managers like Warren Buffett, Lilu, Nick Sleep, which I really like, Peter Lynch, and you can read through some of their past letters that they've written. I've left a link here in the description below. If you use my link, you can get 15% discount off your subscription plan. But hey guys, on a final note, after all I shared with you guys up to this point in the video, right? If you find everything to be overwhelming, right? You have, and let's say you have no time to perform due diligence because of your day job, don't worry about it. You don't have to commit to stock picking. Because remember, 90% of fund managers that do stock picking, right, they don't beat the index. I have no illusions myself that I will beat the index, to be brutally honest. So on average, if you are simply riding the index investing wave and you invest in a broadly diversified low-cost ETF like the S&P 500 for the long-term horizon of decades and beyond, you are already in the top 10% of investors. So I hope you enjoyed this episode, everyone. There might be some delays before I release the next episode because I suspect my son is going to be born very, very soon. I've been waiting since last week and it's still not out. So we've been going in and out of the hospital. I've decided to name my terrapin son Edward after the great Warren Edward Buffett. I hope you enjoyed this episode, everyone, and may the turtle compounding spirits be with you. Thank you for watching.